Welcome to Mortgage Minute with Aaron Moore, JFR Home Loans and Equity Real Estate. Today we're going to talk about some of the basic differences between a conventional and an FHA loan. Jump right in. An FHA loan is backed by or insured by the Federal Housing Administration. It's only for primary residences, so you can't buy a second home, you can't buy an investment property. It's just for you. And it's going to allow for a higher debt to income ratio. So for example, FHA allows for up to 55% debt to income. So your total debt can't be more than 55% of what you bring home before taxes every month. And it also has a little bit less stringent credit requirements. So you can get an FHA with a little lower credit score. A conventional those are sold to Fannie Mae or Freddie Mac, and they require higher credit scores typically, and the substance of your credit has to be a little bit better, but they also don't allow for as high of a debt to income ratio. So they'll only go up as high as 50%. So something to keep in mind. First time, you can do a 5% down conventional, but as a first time buyer, they have a program where you can do only 3% down. So that's pretty strong, stronger than the FHA. Another thing to keep in mind is with the mortgage insurance. Mortgage insurance is placed on a loan if you haven't put down 80% on a conventional loan. Now, if you put 80% down on a conventional loan, you're not going to have additional mortgage insurance, which is a couple $100 a month sometimes. That basically guarantees that if you default, they'll be made whole. Now, FHA, they do not give you that. They basically have mortgage insurance regardless of your down payment. So another example on conventional is if you put down only 5 or 10% and equity increases and you've paid your loan down and it gets to 80% or lower loan to value, then the mortgage insurance automatically comes off. With FHA, it does not. You have to monitor that yourself and then refinance it and go with a conventional loan if you want to get that mortgage insurance taken off. FHA allows for example, if you had a foreclosure, they're a little less restrictive on some of those. So one example is on an FHA, if you had a foreclosure previously, a conventional is going to make you wait 7 years for an approval, whereas an FHA only makes you wait 3 years. Now FHA, because they are less strict, they have higher closing costs and fees, but one of the benefits is with the FHA, they allow for greater seller concessions to pay for more of your closing costs than on conventional. So the seller can kick in more on an FHA to help you cover your costs. And FHA also has, on that note, upfront mortgage insurance. It's a one-time fee. It's 1.75% that gets tacked onto the loan and rolled into the loan and just added into your payment. So you don't have to pay it up front, but it is a fee that's added on. So it's a more expensive loan. But it is a good option for people to get into a home. We do quite a few of them because not everybody qualifies for conventional, and sometimes you might have great credit, but you have a lot going on and your debt to income is over 50%. Well, we'll go ahead and look at an FHA option, because typically an FHA rate is going to be cheaper than conventional. So after you add in all the fees and everything, you're almost on par with what a conventional rate would have been. So it's not necessarily a bad idea, even though there are more fees involved. But that's it. 4 minutes of this, and it really only covers the basics. But if you have any other questions, feel free to reach out. Thanks for watching.